So the IRS generally will look at your day job, right? And if it's not in real estate, they're probably going to disqualify you. What is real estate professional status? Sometimes you might see it as reps. This for real estate, it's very specific, right? It's not a casual, like, oh yeah, I'm going to consider myself a real estate professional. You're not even by default like, oh, I'm a realtor, so I'm a real estate professional for tax purposes. Not necessarily, right? There's some very, very specific rules to get us this very specific designation, and it comes with a lot of benefits. So with those benefits sometimes come IRS scrutiny, right? The IRS might look at it a little bit more. So let's start off. What is this status, right? How do you get there? So to be a real estate professional, probably the number one thing you've heard of is the 750 hour rule. What it means is you're spending 150 hours working in real estate, and that's across the calendar year. So January to December, you're spending 750 hours on a real estate activity. Now, the next piece of this is that it has to be more than half of your working time. Someone tells me, oh, I'm a surgeon, but I have a rental property and I spend all my free time, all afternoon, all weekend, when I'm not in the OR, I'm working on my rental property. Well, unless you're working more than half that time on that rental property versus whatever your other job is, you're probably not going to. So the IRS generally will look at your day job, right? And if it's not in real estate, they're probably going to disqualify you, right? You'd be hard pressed to say, I'm going to spend more time working on my rental property than doing brain surgery, right? So that's how the IRS takes a look at it. Like, no, you're not doing that more than you're not doing that real estate more than you're doing your main profession if you have some other profession. So those are like the key things that we're really looking at as to, am I a real estate professional, right? Now, well, it's real property, trade, and business. And I like to tell people, think about very hands-on type of real estate activities. If you're a property manager, right, you're having to go and deal with the tenant, real estate profession or real estate activities, trades, business, services. If you're a realtor, you're showing properties. You're a broker and you have realtors working under you. Things that are very hands-on. You're in construction or reconstruction, or you're doing redevelopment, right? A lot of these types of I'm out in the field or I'm doing stuff in real estate day in, day out will count towards real property, trade, and business to hit those 750 hours. Now, you do have to be careful of some things that don't really qualify, which they say are more like investor activities. Well, to answer that question, we have to take a look at how rental income is treated on your tax return. Rental income by default is considered passive. I like to think of income as being in different buckets, right? You have one bucket here. This is your passive bucket. Things like your business income, U2 income, stuff like that is non-passive. It's in a different bucket, and those two buckets cannot wash each other. What stays in one bucket does not go in the other bucket. Now, a big exception to this on rental income and rental losses is if you're a real estate professional. Because if you have that status, suddenly that income from rentals that otherwise would be considered passive is non-passive. And that means the losses can offset other income in those non-passive buckets. So that's super, super valuable, right? Now, remember, we've got bonus depreciation again, right? That one came back in the One Big Beautiful bill. So if we're going to take a property and we're a real estate professional, and if it's running at a loss, we can take that loss and offset. Now, generally speaking, real estate doesn't on its own generate bonus depreciation. But if you combine that with a cost segregation study, which will separate out your bonus depreciation eligible asset, now you can take a big chunk of that depreciation of that real estate property and throw it in that loss generating bucket, now non-passive income, and it can set off other income. So what's a great use of this? If you think about having two spouses, right? Maybe one's a real estate professional and the other has a day job, right? Especially if they're earning like a decent amount on a W-2. Say you're like an attorney, right? That real estate professional spouse can generate a very large non-passive paper loss by combining their real estate professional status, their cost segregation, and their rental property all together to generate a big loss in that year. And it can offset the W-2 of their highly paid attorney spouse, right? This is a fantastic strategy. We love this strategy. There are other ways to do similar things, not exactly the same, but we're talking about the real estate professional status. So that's what we're looking to do. Is this something that you're thinking about? I had multiple people today ask me about this. It is popular, right? If anyone thinks that the real estate market is like on the decline, there's still plenty of people, at least in the like Miami area, still getting into real estate. We're gonna use and abuse the One Big Beautiful Bill and that bonus depreciation, and we're gonna mitigate some taxes in a completely legal way. Questions? You have any questions? I'm sure that's totally clear. That's what we're here for, right? We're here to help explain these things. So if you have any questions, if you're thinking about utilizing any of these strategies and you don't know where to start or you don't know if you qualify, get in touch with our office. We're absolutely happy to help guide you through it and help you make sure that you're doing it the right way and qualifying, because it would sure stink to not qualify for that real estate professional status after doing all of that work. So get in touch with our office and we will see you next time.